I'm Leah Boleto and this is the Sky News Daily, and today we're talking about interest rates. Well, the Bank of England has raised the rate for the 14th time in a row.
Today we've increased bank rate by 0.25 percentage points to 5.25%. Low and stable inflation is the foundation of a healthy economy. High inflation hurts the least well off the most.
So how does this fit into that target of getting inflation down to 2%? And most importantly, what will it mean for savers, mortgage holders and actually renters too? Now, we know why mortgage holders usually get the attention on a day like today, but they're actually in the minority in England and Wales now, with more people renting and more people owning their own homes. So let's go over this then with our business and economics correspondent, Gurpreet Narwan. Gurpreet, good to see you. So here we are then, 0.25% increase from the Bank of England. Were we expecting this?
Yeah, so the headline figure is 5.25%. It's a 0.25 percentage point increase from the Bank of England today. It was widely expected from economists. So most economists were penciling in this increase. There were no major shocks. It now marks the 14th consecutive interest rate rise since December 2021, when the bank first started raising interest rates from a record low of 0.1%.
So what's been the reaction? Because Labour will say, actually, it was the Conservative government that, I suppose, accelerated with their mini budget the hard times that people are experiencing now.
Yeah, I mean, there are a lot of causes of inflation that all interact. The major one, the biggest issue that we had to start with, was imported inflation. So it was the energy crisis, it was the war in Ukraine that triggered a massive spike in gas prices. And we're really vulnerable to that in the UK because we use a lot of gas to heat our homes. We've also had a huge increase in food price inflation. We've had supply chain bottlenecks all over the world that have affected our food supply. Brexit has played a part in it and the effect that it's had on the value of the pound. So that's one side of it. But then there are also other issues at play. In Britain, we have a really tight labour market at the moment. During the pandemic, lots of people left the world of work. And when our labour market shrinks in the way it has, that puts lots of pressure on wages. And when wages are rising in the economy, that can fuel inflation even higher. It's something the Bank of England is keeping a really close eye on. So a lot of different things involved here, all fueling inflation in the economy.
It's a big juggling act, isn't it? And is there any optimism that people can hold on to?
Yes. And I'll start a month ago. Because a month ago, it looked like interest rates were going to peak at above 6%. And then we had the inflation data. And the inflation data showed us that inflation is actually falling faster than we expected. So it came in at 7.9%. Now, that's still almost 4 times the Bank of England's 2% target. It isn't a massive reduction, but it showed that the inflationary trend was moving in the right direction. So before today's announcement, some thought that the bank might have to raise interest rates by 0.5 percentage point to 5.5%. But that good news on inflation means that it's only had to raise rates to 5.25%. And the peak, so the peak where we expect interest rates to end up before they start coming down, has also come down to below sort of 5.7% now. So as I said earlier, before all of this, we were expecting a peak of above 6%. Now, what is really interesting that's come out of the Bank of England's report today is that although the peak of where interest rates may end up, according to the markets, has come down, the bank has really strongly hinted that rates are going to have to stay higher for longer. So if you're a mortgage holder and you thought you might be able to ride out the next year and a half, and then you could start benefiting from falling interest rates, well, it's not going to be as straightforward as that. We're getting used to a new normal of high interest rates. It looks like interest rates could be 5 or above 5% for a few years at least.
What are the government saying at the moment? Because it's one of Rishi Sunak's pledges, isn't it, to get inflation down. He's on track to do that then?
Yeah, so this is where it gets a little bit interesting because the government has set itself a target to halve inflation by the end of the year. So they're saying, judge us on whether inflation is half the level it was at the start of the year. And that's about 5.4% is the rate it needs to meet. The bank today said the government's going to meet that. So inflation will end the year at 4.9%. The Treasury will be celebrating that. The Prime Minister will be celebrating that. However, there's a more important target, and the more important target is actually the Bank of England's 2% target.
Yeah.
So although the headline rate of inflation will be halved by the end of the year and the Chancellor will meet his aim, actually to get back to 2% is now going to take longer than we thought before today. So prior to today, we thought we'd be hitting the 2% target by the first quarter of 2025. It now looks like we're going to be hitting that in the second quarter of 2025. That could also explain why interest rates are going to stay higher for longer as well.
So that's a headache for people with mortgages and savers also. You know, this would have been a really good time for them to get a bit more back on their money. It's not necessarily happening as fast as it should.
Yeah. So interest rates work in two ways. So when the Bank of England raises interest rates, it's trying to dampen demand in the economy. It doesn't want people to go out spending. It wants them to stop so that prices come down. Now, there are two kind of main transmission mechanisms for this. There's the borrower side and the saver side. On the borrower side, you hike up people's mortgages. They don't have as much money to spend on other things, so that reduces demand in the economy. On the saving side, if you hike up the savings rate, which higher interest rates should also translate into higher savings rates, then people are more incentivized to keep money in the bank account instead of going out to spend it. Now, the problem is the banks aren't passing on higher interest rates to savers like they are to mortgage holders. They have been passing them on. They are doing better, but they're not passing them on nearly as quickly enough as they are passing them on to mortgage holders. And you can see that reflected in the kind of profits that banks are making. And there's a lot of pressure now from MPs and from the government on banks to do better on this and to give savers a fair deal.
So what are people saying about how the Bank of England have been handling this? Because it does feel like a bit of a gamble here, because there are some voices that say this could potentially tip the UK into recession. That's a worry too.
Yeah, it's really, really difficult to make the right judgment because it's a balancing act. And I think this is a really good reminder of how economics and monetary policy, it's not a science. It's, based on judgments. It's very much an art. And that was really illustrated in the vote by the members of the Monetary Policy Committee when they were deciding what to do with interest rates.
And what's their role in this? Because they were split a bit, weren't they?
Yeah, exactly. So the Monetary Policy Committee, it's 9 economists. They vote on what we should do with interest rates. So this decision today was based on the votes that they cast. And the vote was split. It was 8-1. So 8 members voted to raise rates. 1 member voted to leave rates unchanged. But actually, there's a bigger divergence of opinion than that headline suggests, because within the 8 that voted to raise rates, 2 voted to raise them by 0.5%. And actually, we got them to 0.25%.
Oh, my goodness.
So actually, what that's showing us is that there's a huge divergence in opinion about what the best course of monetary policy is right now. And part of the reason it's so difficult is because although we've raised interest rates pretty aggressively since the end of 2021, we haven't actually seen the full impact of it yet. It can take up to 18 months for us to really see the impact. So in the past, a larger proportion of households had variable or tracker mortgages. Now, so many more people are fixed. And that means if you're on a fixed rate mortgage right now and you're rolling off, at the end of the year, you haven't felt any of this yet, but you're going to feel it pretty acutely by the end of the year. So there's a lag. It takes a while for all of this to pass through. This year, 1.4 million households are rolling off their fixed mortgages. We still don't know what the full impact of these interest rate rises is going to have on the economy.
So look, we've had a really bumpy 18 months for everyone. The next year or so for many households is going to be really tough.
Yes, it's going to be tough. So the Bank of England is saying that we're going to avoid a recession. But a recession is a technical term. Although we're avoiding a recession, we've still got 3 years of really meagre economic growth, close to zero. That's partly because interest rate increases are doing their job. They're meant to slow down the economy. That's a huge hit to people's living standards when you're spending this much extra on your mortgage. Although we believe that inflation will fall down fairly quickly, that the Chancellor will meet the target of halving inflation by the end of the year, there's a real risk that might not happen.
Yeah, and it's whether voters feel that in their pockets each month, and that will be the big test, won't it, Gurpreet?
Yeah, it's not great coming up to a general election for the government to be in this position.
As we heard from the Governor of the Bank of England himself at the start of this episode, the bank's interest rate is supposed to help and protect the most vulnerable from prices getting out of control. But journalists from Sky's data and forensic team have found that rising rates may actually be hitting some of the most vulnerable people hardest. Daniel Dunford has been looking into this. Thanks for joining us, Dan. Now, with any kind of announcement from the Bank of England, mortgage payers biting their nails, wondering, how it will affect their monthly payment. But actually, what you guys have found on the data team is that renters are quite exposed.
Yeah, it seems sort of counterintuitive, really, I suppose, to talk about renters when obviously the people that are directly affected by the interest rate raises are people with mortgages. But obviously, renters, a lot of them, 60% of them, in fact, the properties that they're renting will be mortgage properties. And actually, many more of those will be interest only than people that pay mortgages on their own home. So if it's an interest only mortgage, you're obviously a bit more exposed to the rate rises than you would be if you're paying part repayment and part interest. And I think actually the best way of thinking about it, actually renting is sort of the worst and most variable rate you can get on paying for your home, because you're not just subject to interest rates that may impact what your landlord is paying and which they may choose to pass on or may choose not to pass on, but you can be just sort of subject to the whims of your landlord or their own financial situations.
If you could just talk to us about the headline figures here, because actually we're not a nation of mortgage holders, are we, anymore? Tell us in England and Wales what the situation is.
Yeah, so at the moment there are 30% of the country is mortgage holders, so slightly less than a third, and slightly more than that, exactly a third actually, is people that own their homes outright, so they've finished paying off their mortgage and their housing costs are effectively zero, other than maintenance.
Yeah.
And then that biggest group is renters, so that's 37%. It's 20% in private rent and 17% in social rent.
Over the last few years, this has been happening. And what are we talking, like 10, 20 years?
Yeah, I mean, it's been a sort of a long-term trend. I don't think it's particularly surprising to hear that, we've heard before about how young people can't afford to get on the housing ladder. And renting has actually been the most popular way of paying for your home, as in the most common way of paying for your home, I suppose, for most of the last 10 years. But it's that mortgage holding percentage which has really slid recently. And that's because we're seeing people paying off their mortgages going up, but people not sort of joining that mortgage cluster on the bottom end.
And who are these renters? Who is it affecting more?
It is mainly younger people. 2/3 of younger people are renting. That's people between the ages of 16 and 34. But it's not just young people. Even in the oldest category, the over 65, so 71% of that category own their own homes outright. They finish paying off their mortgage. But there's hardly any people left paying their mortgage. There's still about 25% paying rent, a lot of them in social rent, a few in private rent as well. And the problem for those sorts of people, both at the older age end, but also the younger age groups, is often the same people that have lower savings. They might have less of a support blanket around them. And that leaves them more exposed to changes in their sort of monthly outgoings, and housing costs, obviously, usually the biggest one of those monthly outgoings.
So you and the team, did you speak to any renters and what did they tell you?
Yeah, we spoke to one in particular. Her name was Andy, and she's 51. She's got a 14-year-old son. She's been living in her rented property for the last 9 years. And the rent's sort of been going up £25 a month every year.
Which is affordable,
year,
isn't
which
it?
Yeah, that's an affordable change.
Yeah.
But then after the pandemic, the landlord put the rent up by £75, which, the pandemic, there hasn't been any rises, £75, okay. But then less than a year later, he's asked to put it up again by another £100. Andy tried to sort of question that and say, this is actually really getting unaffordable to me now. You only put it up by £75 less than a year ago. And then at that point, they said, well, actually, what I really want is not the £1,200 I'm asking for you now. I want £1,425, which for someone in that sort of situation where, a single parent, it was eating into almost all that was left of her monthly budget, which she's got left to pay for, everything else, your food, your travel, your clothes. So she was already relying on family members to help out with that stuff. Then can't afford that. And then the landlord just issues a Section 21, which is a no-fault eviction notice. So it's not saying we're evicting you because you've stopped paying your rent or you're not paying on time. That's never been the case with Andy. And we're seeing lots more of these Section 21 notices going out to people now. And that's because the market rates of rents are going up. And often it's harder for landlords to ask existing tenants to pay those higher rents. It's often easier to evict someone, get someone else in. But, you know, this is the place she's lived for the last 9 years, the place she's made her home, and it's really difficult.
OK, Dan, wait there, because we'll come back to you in a minute, because I want to bring in Tilly Smith from Generation Rent, a campaign group that works to improve the rights of renters. And Tilly says they're seeing more people in positions just like Andy's.
It's tough times for everyone, not only with mortgage rate increases, but also with the continuing cost of living crisis. I will say that it is quite complicated. It's not necessarily a cut and dry case of mortgage rates are leading to higher rents. Rents are going up. Our latest figures show that 60% of private renters have had an increase to their rent in the last year, but only 12% of those who have had a rent increase said that the landlord had blamed it on increasing mortgage payments. And more likely, and in fact the most likely reason for rent increases given was just that the general market is going up and landlords are kind of using it as an opportunity to up the rent. So there is clearly a trickle-down effect where mortgage increases are getting through to renters, that is having an effect on renters, but there is also a wider issue of just rents are going up for a variety of reasons in a very worrying and concerning market.
And just tell me some of the stories that you have heard from renters. People must be coming to you and saying, look, this is what we're faced with. I mean,
you say to people, how are you coping with it? How, are you sort of choosing between the rent and food? And they say, well, I have to choose the rent. I can't. The very last thing a person will not pay is the rent. They will go without food. They will go without heating before that happens. They're also going into debt in other ways and the few that do have savings are obviously gouging out the last of their savings in order to cover these costs. And it is just extremely stressful and distressing. And, you know, people have talked to me about how they're depressed, and it's extremely traumatizing.
Landlords will say, look, you know, we're just passing on the increases to our tenants, and that's fair in a business relationship, right?
It's, you know, I can understand it's difficult for some landlords to afford increasing mortgage payments. It is also worth mentioning that about 4 in 10 landlords don't have a buy-to-let mortgage. So lots of landlords aren't affected by the mortgage increase. So there's no real excuse for them to be increasing the rent at this time. It is effectively, you know, easy for landlord to increase the rent. It's often impossible for renters to just magic up a new source of income. And these are real people's lives that are being affected. And the reality is, if you can't afford the rent, you are very likely to become homeless, and that can't be allowed to happen.
And that's the thing, isn't it? For renters, I had a friend who called me in tears because she said she got a message from her landlord that said, from next month, your rent is going up by £480. Not much of a warning. And that's what she was faced with. She's a single mum with 2 kids. And that's the problem, isn't there? There doesn't seem to be a safety net or anywhere people can go to. What is in place?
The sad truth is there really isn't very much. Landlords can very arbitrarily and very easily just put a rent increase to tenants, and you can challenge that. You can challenge that in a tribunal, but it's a very difficult system. It's not especially accessible. Very few people know about it, and ultimately, a landlord can turn around and say, even if they aren't able to get the rent increase that they want, they can still quite easily evict a tenant with something called a Section 21 no fault eviction. So they can simply just remove a tenant from the property and get in someone who will pay that increase. So it's very much against tenants at the moment who are sort of experiencing the sharp end of the housing crisis.
OK, Dan, Tilly is saying, although there's some opportunities for people struggling with rent rises to challenge them, ultimately, renters' rights are pretty limited. But the government are working on legislation to change this, right?
They're working on it is probably the best way of putting it at the moment. So there's a new renters reform bill which is trying to go through at the moment with Michael Gove, exactly. And that aims to stop these Section 21 notices, which for those people that are already facing eviction, it's not going to help those people. But I think it would bring it a bit closer in line to some of those European countries that have a bit more of a rental model embedded in their national psyche. So whereas what we found is that we've become a rental economy almost by accident, I suppose, over the last 10 years. I think that part of our national psyche is built up in Margaret Thatcher talking about the property-owning democracy. And everyone
the
having
right to buy your council home was
yeah.
such a big influence, wasn't it?
And everyone having a stake in the country they live in was a big thing of hers. And, an Englishman's home is their castle. But now it's an Englishman's home is someone else's castle. The national psyche feeds through to policy in a lot of ways. So in these European countries, there are often better protection for renters in terms of agreeing long-term rent. So you agree the rent that you're going to pay for the next 10 years, and then it's not going to change. It's much more difficult to change rents, much more difficult to evict people. And also, although obviously we're talking about how mortgage holders are exposed to these interest rate rises, mortgage holders are also empowered to negotiate with their banks.
Absolutely. You can go and shop around, can't you? But in the renting world, doing that means packing up your stuff, finding somewhere if you can. And it's harder, isn't it? And there isn't that protection for people who are renting, and that's a problem.
Exactly, yeah. Banks don't want their mortgages to fail. They will do all that they can to make different payment plans. You can extend the term or you can go to interest only for a certain time. Whereas landlords, they don't have that interest in the tenant necessarily. Obviously, there's a human interest that you'll have, but it may be easier for a landlord to ask their tenant to pay them more rather than to go to a bank and sort of start paying off their mortgage a bit slower. If we start to think of ourselves more as a rental-based economy, then we can start to think about how to prioritise those sorts of people and make things a bit easier for those sorts of people, which are in the majority at the moment. So it's not about making things worse for mortgage holders or anything like that. It's just about making renters' lives, which is 4 in 10 of us, a bit easier.
Well, that's all from me on the Sky News Daily podcast. Thanks to Dan and Tilly and also Gurpreet. We'll see you again tomorrow.